In the good old days when you were borrowing money for a house, you went to a bank, and the bank lent you money, and you had a mortgage. The bank would fund that mortgage from deposits, checking accounts, savings accounts that the bank had. Now, over time, they took those mortgages because some banks wanted to lend more out in loans than they had deposits for. So what they do is they would sell off those mortgages to an investor, then they could go and lend money to somebody else because there's fees involved with that upfront borrowing of money. And over time, those mortgages were sold in pools. So they get maybe 1,000 mortgages together, pool them together so you don't have the risk of an individual homeowner or individual house. Maybe you get some geographical, what's the word I'm looking for? Dispersion, different houses around the country, so if hurricanes hit or earthquakes, the pool isn't all exposed to fires in California, that's it. All right, so this, like Wall Street loves to do, they keep taking this further and further and further. And so during the end of the subprime heyday, it was 2007, some investors, like John Paulson, who runs a multi-billion-dollar hedge fund, thought that the housing market had reached a peak and that the banks were lending money to people who had no business borrowing money. You guys ever heard of a no-doc loan? That ring any bells? Well, again, back in the good old days, if you want to borrow money, you have to do two things. One is you said, okay, my house is worth $100,000, the house I want to buy. The bank will say, well, I'll loan you 70 or maybe 80,000, and the rest you have to put in. So if the house drops in value, the bank doesn't get hurt. It comes out of my pocket or your pocket, right? And so you need to have a big down payment. And the other thing you need to do is to demonstrate that you had a job that had enough income to make your payments. And it seems pretty straightforward, right? Pretty reasonable. Well, as we got kind of crazy here in 05, and 06, and 07, people couldn't afford to buy these houses anymore. So the bank said, well, okay, instead of putting 20% down, let's put 10% down. And then it was 5%. And at the end, people were putting down negative 3% or negative 5%. So how's that possible? So when you close, they give you money. So you can put in a swimming pool or go buy a boat, right? Makes perfect sense. So you're borrowing maybe 105% of the value of this house, which is probably already overvalued. And the banks said, well, we're not going to verify what your income is. You just tell me what your income is. They call it no doc loan. You didn't have to have any proof at all. You just wrote down, I make $1 million a year. And they said, great, we'll loan you $2 million or $3 million, whatever it is. And so the official name was no documentation loan, but you probably heard them called liar loans. Because they're encouraging lenders to lie, borrowers to lie. Because no one's going to verify what happened. And this is all based on the belief that housing prices would go up forever. So if housing prices go up forever, it doesn't matter that you don't have a down payment. It doesn't matter if you don't have an income, because the bank can always just sell the house and they'll be fine, they'll be made whole. So John Paulson and others decided that this maybe didn't make a lot of sense, and that the housing market was due to fall, and the subprime, which was the low credit borrower, was buying houses, and again, people making, say, $30,000 were buying $800,000 houses. It just didn't make any sense. They could not afford these houses.